So we also have this area here, which is a what? Fair value gap. But think now, if this is an inefficiency and it's a fair value gap, what kind of fair value gap is this? Buy side imbalance, sell side inefficiency, just like this one is down here. But what does this become if this area up here is creating some measure of a likely price delivery going lower? And then we see support behind that idea where price does this very thing here. As soon as this candle trades down below these lows and below this candle's high, which is the low of this buy side imbalance, sell side inefficiency, which is a fair value gap, this pass through of this candle here makes this and this a potential what? Inversion fair value gap. What time frame does it form on? The daily chart. See, we're up here, daily. So your annotation here is the daily inversion fair value gap high, which is this candle's low, and this candle's high, which is the daily inversion fair value gap low. An inversion fair value gap is narrative based. If we take away the context of it wanting to go lower, prior to this lower, this is just simply a fair value gap, buy side imbalance, sell side inefficiency. But as soon as we have price deliver to the sell side and then attack sell side liquidity and pierce the low end range of that buy side imbalance, sell side inefficiency, this sets the tone if narrative is considered, and we've already established that early on that we were looking for lower prices. So that means we can use the midpoint or the low or the lower quadrant. Notice there's 3 specific levels there. Not a zone, very specific price levels. Midpoint, well, what's the midpoint of an inversion fair value gap? The same thing that we would call the middle of a fair value gap. The same thing we would call the middle of a wick or a tail, consequent encroachment. So we see the daily inversion fair value gap, consequent encroachment, is right there. Notice we have this inefficiency here, which is what? Daily fair value gap, SIBI. So anyone else watching my videos, if they don't really go through the process of doing this or learning or take good notes, they're going to assume that the market's going to go all the way back up to here because they'll say this is a liquidity void and the market's going to want to have to go up there. Not when it's like this. Like what? We have a higher time frame monthly fair value gap. We went up and repriced to it. We went up to it one more time, halfway, consequent encroachment. And we also rebalanced this area here because we went up into repricing it and then we left the range there. So now this is a balanced price range. And we had 1, 2 premium arrays supporting what? Lower prices. So as soon as we pierced through this low here, this level here, not that very candle, this low of the inversion fair value gap. We don't know it's an inversion fair value gap until price does this pass through. Then we can anticipate the market likely to reach up into the midpoint between this candle's low and this candle's high, and that midpoint is daily inversion fair value gap, consequent encroachment. So the midpoint between this level here and this level there. We trade up to here, trade lower, and close there. Next candle, we open, trade up one more time, trading above the previous day's high, trading up into consequent encroachment of the inversion fair value gap. And what is this candle here? This big beefy candle. This is for the folks that like to say my order blocks are engulfing candles. That has nothing to do with it. This candle here is the bearish order block. Notice this candle does not pierce or engulf this previous candle. Whoops, there goes that logic. So it's the change in the state of delivery, which is the opening price here. As soon as that opening price is pierced to the downside right there on that candle, this becomes a bearish order block. Now, because this is an order block, we can take that range from the low to the high. Halfway point of that is what? Consequent encroachment? No. Mean threshold. So we extend that to the future, and it would be in this area here. But we have what? What do we have here? We have this inefficiency from this candle's low this candle's high. Would we reasonably expect, if we have the inversion fair value gap consequent encroachment, which is half of this buy side imbalance, sell side inefficiency, the midpoint of that, if we have that, and we have the opening of this bearish order block, and potential institutional order flow entry drill, we're expecting lower prices, and we have an inversion fair value gap. Can it go back up to the inversion fair value gap high? Yes. The chances of it doing that are slim. By far and large, many times you're going to see that inversion fair value gaps, given this type of movement where we've moved up 5 months one direction, we hit a premium array, there's no reason really to go up to the high of the breaker, and because the breaker is essentially a pattern that you want to trade the low or mean threshold of. You don't want to see it trade the high end. If it does, it becomes a little less likely. Doesn't mean it can't go there. It just means that I don't like to see that. And if it does that and I'm in a trade, I will scale something off to remove the measure of risk that I'm holding if I see it trading to the high of the breaker. Because if it trades to the high of the breaker, it means that it's not as bearish as I want it to be. And you don't want to see it trade up there. If it's bearish, it shouldn't get all the way up there. Same aspect that's being shown here. If we have this SIBI from this candle's low and this candle's high, and we have this one big candle trade down like that, do we really want to see it trade above the daily inversion fair value gap high? No, we don't want to see that. Just like we wouldn't want to see it trade on the monthly bearish breaker high. Because if it's bearish, we want to see premium arrays not be reached to. Let me say that again. If we're bearish, if we see premium arrays in our PD array matrix, in the fractal that we're studying in price action, that means all the data that's being shown here. If we can clearly identify where specific liquidity resides or where a premium PD array is in price, if we're really, really bearish, we do not want to see premium arrays traded to. We want to see discount arrays draw price to it. And everything smash through down close candles. Because what is that telling us? Order flow is bearish. Everything is in the candlestick. Everything. You just need to know what it is you're looking at by time. So we also have the weekly premium wick consequent encouragement, which was being respected. Look at the bodies right there. See that? Did any of the bodies cross over that? Nope. But we did have wicks go through it. And that also teaches you what? By annotating your chart like this and seeing how the lower time frames go through it just a little bit. But when it does that, and if you're bearish, you're going to start to condition yourself and say, okay, this is acceptable. And this is why I say this is permissible in price action, where you might get scared out of it, or you might put your stop loss just above that, thinking that it's enough. It's not enough. But I'm not scared or changing my opinion about where the market's going to go because there might be a small little mohawk, little deviation outside of the levels I'm looking for. This is all normal coloring outside the lines. Okay? This algorithm is my baby. It's my child. So when I look at price action and it colors outside the lines, I'm still going to take this chart and hang it on my refrigerator, hang it on my desk. Okay? It's something my child has done. And I know that this is my child's fingerprints. So I don't worry about these things when I'm looking at it. And I'm not judgmental of what price did in these areas when it's normal to see that very thing. And you won't grow anxious when you're studying price and it's behaving this way because it's something that you expect and it's likely to occur. Where everyone else might get scared or stopped out, or they may even change their opinion about where they think the market's going to go because the market creates these little wicks. At the time watching it, this is a full-blown bullish green candle. At the highest high of that, when it touches the candle low there, real time, I'm expecting it to just bump just above it a little bit and then recede back into the range. When you start doing these types of annotations, it conditions you to anticipate that very thing. So when you were watching real-time price action or tape reading, You will have that in your mind because you've seen many examples of it. And then when you start getting real comfortable with it and it happens to do that very thing, it feels really good. So we wouldn't want to see this area up here in this SIBI be traded to. We don't want to see that because above the daily inversion fair value gap high, we have this separation from this candle's low and the high, which is this candlestick low. That's the inversion fair value gap high. But then the market opens here on Wednesday. We open, rally up, and then crush the sell side liquidity. And we go below the low, the daily inversion fair value gap. That makes this low a real low of the inversion fair value gap. The market trades the next day on Thursday. It opens, rallies up, touches the low of this candle here, which is what? That's your bearish order block. It can trade to that level and up to the opening price. Can it just stop and dead in its tracks? Yeah. But what do we allow for? Coloring outside the lines. So that opening price extended forward, what are we seeing right here? The same element of price delivery that's going on right there. This is a mohawk. This is a mohawk. It's absolutely permissible. Why? Because the market dynamics and the underpinnings of the marketplace is it's wanting to go lower. So it's willing to go lower, likely to go lower. Anytime it goes to a premium array that does touch, it does deliver to, anticipate a little bit of coloring outside the lines and not freak out thinking it's going to give way, which is the reason why I have a rule of 3 PD arrays. One, the first one, it can do this and then that's all there is. It can do this and then trade into the second PD array that I would be viewing as a defense. But if I have 3 PD arrays, if I'm bearish, if it trades through 3 PD arrays, I'm probably wrong. And if I haven't been stopped out, I'm going to take the trade off and remove myself from risk. So this area up here becomes what? Between the daily inversion fair value gap high, which is this candle's low, to this candle's low here. That makes this what? A breakaway gap. Ooh, it's not annotated. Right, it's for you to go in and dig into it. So we see it trade up into the bearish order block, opening price, and trades above this candle's high right there on Friday, which is a institutional order flow entry drill. What is that? It is a entry taken that would be inside of a imbalance like a fair value gap. What is this? It's a fair value gap. It's shaded. It's a daily fair value gap. What kind? SIBI. That means it's a down candle that delivers the fair value gap. Just the opposite of what a BISI is, okay? We don't want to see this area traded to because why? We have this high here that it could trade to and create a turtle soup. Trade up above it and reject and go lower, which is what it did. But how far can it go above that high, CT? The opening price here. This is your bearish order block. That's your change in the state of delivery right there. And it can go up to that area there and go through it just a little bit, which is permissible price action. Coloring outside the lines. And then we see delivery aggressive throughout the day and going lower. Taking out Thursday's low. And now we have elements inside of the 4-hour chart like we see here. The 4-hour bearish order block right here. Change in the state of delivery is there. Market opens on this 4-hour chart, trades up. What's it doing? It's trading just above that candlestick's opening price. This is permissible price action. This is a mohawk. Okay, it's just a little bit outside the lines. That's absolutely permissible. The market trades there, lower, opens here and moves lower again. This area in here is indicating that inside of this daily fair value gap SIBI, there's a little bit more detail as to why we would not reasonably expect the daily chart to see price action go above that daily inversion fair value gap high. Why? Look closer. From this candlestick's low to this candlestick's high, that is your daily fair value gap SIBI. This is the daily inversion fair value gap high, the midpoint of that inversion fair value gap, which is consequent encroachment, and the low of the daily inversion fair value gap low. So here's consequent encroachment. Why did we not expect it to trade up in this area here? On the daily, it was showing one single pass. But on a 4-hour chart, you can see it went down. And then the next candle we opened and went back up there again, and then down. Down. Delivery in here as well. So what is happening here? Went lower, 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 back up, lower. So this is what? Balanced. So this is a balanced price range. So what do we have from the daily inversion fair value gap high to the daily inversion fair value gap consequent encroachment? We have a balanced price range. Nailing the bearish order block opening price, coupling it with a confluence of the daily inversion fair value gap consequent encroachment of that gap on the daily chart that we saw trade through it here, and then we expect the midpoint of that to act as what? The high on Friday. It's not likely to go all the way through all this just to get back up into a little area here. Let me go back up to the daily chart. Think about this little area right here. Okay, now I'm going to show you that on the daily chart. That's this little area right there. Go on your own charts and you'll see what I'm talking about. This little area here is not likely to see all that trade back up to. This is going to stay open. Why? Because on the 4-hour chart, this is all balanced back and forth price action. So there's no inefficiency. There's no liquidity that's necessary to trade to. So when we trade down through the daily inversion fair value gap low here, our attention goes to the daily inversion fair value gap consequent encroachment, and the likelihood of that becoming, or just a little bit above it, like we see here, creating the Friday high. And we trade up, small little mohawk above the bearish order block, opening price, which is a change in state of delivery, just a little bit above the daily inversion fair value gap consequent encroachment here, and then we see what? Non-farm payroll rip through it and then attack the low here. There. Digging into that daily fair value gap, buy side and balance, sell side inefficiency. Now notice in here also we have this down move here. In the next candle we open, and when the candle opened here, this wick hadn't formed yet. So between this candlestick's low and where we opened, this candle was just one single pass down, which would be looking much like a what? Fair value gap SIBI. But this candle does what? Immediately trades up, hits the low and goes just a little bit past it. What is that? It's permissible price action. And trades lower. That is my immediate rebalance. When it does that, whenever it does that, and you have a bias that's bullish or bearish, in this case, it immediately rebalanced here. That is one of the strongest algorithmic signatures you're going to ever see in price action. I'll have much more to talk about that in my books, but for here, I'm just reminding you that I've already mentioned it here on my YouTube channel. My long-term students know about this intimately, but this immediate rebalance is one of those things that tells you that this market's going to be extremely bearish and it's going to move fast. And then we see it run off. So we have a 4-hour PD array in the form of an immediate rebalance, and then we have a 4-hour bearish order block. Apart from that, nothing else on the 4-hour chart is anything of importance to me.